Hey everybody, this is Dylan Bray. Today my topic is risk and return from the learning module, Financial Market Effects on Industry. Risk and return. There are many things to look into before you take a risk, and the most important thing that everyone wants to know is how big is the reward. Below are some ways to figure out just how big that reward is. There are realized returns, which is the total return that occurs over a particular period of time. Average annual returns, which is the arithmetic average of an investment's realized returns for each year. The variance, which is a method to measure the variability of returns, is the expected square deviation of returns from the mean. Normal distribution is a symmetric probability distribution that is completely characterized by its average and standard deviation. About 95% of all possible outcomes fall within two standard deviations above and below the average. Types of risk. Common risk is a risk that is linked across outcomes. An example of a common risk would be an earthquake or a flood. The independent risk are risks that bear no relation to each other. If risks are independent, then knowing the outcome of one provides no information about the other. An example of this type of risk would be theft. Diversification is the average of independent risk in a large portfolio. Risks in stock portfolios. There are two types of risks when it comes to dealing with stock portfolios. There's the unsystematic and the systematic risks. Unsystematic risks are fluctuations of a stock's return that are due to company or industry-specific news and are independent risk related across stocks. An example would be if a company lost its patent protection for its product. Systematic risks are fluctuations of a stock's return that are due to market-wide news representing common risk. An example would be if the FED made the interest rates rise. Review. Understanding risk and return is key to calculating the expected return of a security based on its systematic risk. The owner of a portfolio of securities can diversify the unsystematic risk, leaving only the risk that is common to all companies, which is systematic risk. You always want to know the return before taking the risk. Thank you for your time, and I hope that by viewing this presentation, you have learned a little bit more about risk and return.